Welcome back, audience, to Real Men of Real Estate. I am your host, Paul Matamoros. I'm here with my special guest, Abel Fregoso Jr., and he was just on our last segment, was talking a little bit more about the rates, but I think he might even have a little bit more to share with us on this. So, Abel, please take it away.
Yeah, Paul, before we move on from interest rates, I just wanted to piggyback on what you had said earlier about back when the 70s, 80s, the interest rates were at 18%. So if you look at over the last 50 years, the average interest rate is right around 7.5, because you take that 18.5, 19 of the early 80s, the 2.5, 3 of the 2000s, and you average it out, and it's around 7.5%. So even though rates are going up and we will be at 4%, 4.5%, we are still at historic interest rate lows. And I talk to a lot of buyers that say, oh, I missed the window of the lowest rates. No, you don't look at it that way. You want to buy, because in the last year, the value of property has increased 18.5%. So even if you're at 4%, you still have a tremendous opportunity investing in real estate, even at 4%.
Fantastic. Thank you very much, Abel, for sharing that, because that is important. I think the next, probably what one might think is, okay, so the interest rate is workable, but then a lot of people might even think, well, property has gone up so much that I wish that banks would let go of some of this money. So with that said, let's go into the second question, Abel. What are the differences between QM loans versus non-QM loans?
So let me give you just a little bit of a background, okay? So prior to the Great Recession, we had loan products where if you put a mirror in front of a buyer and it fogged up, you were approved, because that's how loose the guidelines were. They had what they called the liar loans, where you just said, hey, I make this much money, and you say, oh, okay, you're approved, let's do it, don't have to verify it. So once the Great Recession hit, which was really driven by the real estate market collapse, then Congress decided that they needed to tighten up guidelines within the lending industry. And from that was born what was called the Dodd-Frank Act, that promoted only qualified mortgages. Qualified mortgages, or QM, are those mortgages that are your conventional loans, your government loan, FHA, VA, but those loans do not have prepayment penalties. They do not have balloon payments. They do not have interest-only payments, where, before the Great Recession, you had what is called the option arm, where you would allow to pay only interest, and the balance became negative and became what is called negative amortization. So all those products were taken away, and only qualified loans was with Dodd-Frank wanted to promote in the industry, okay? Mm-hmm. What ended up happening is it swung the pendulum way too far to the other side, which meant that we started neglecting a lot of potential buyers who couldn't qualify with these QM loans. Because on a QM loan, we have what is called ATR, ability to repay, okay? And when you have that ability to repay, you're going to get a loan. So you got to document your income with taxes, pay stubs. You got to have money in the bank. You have to have a history of employment for 2 years. So it's a real tight box. So it really left a lot of these potential buyers out of it. But those are the real clean transactions that the industry wants to see. But again, it neglected a lot of potential buyers, especially self-employed buyers.
Exactly.
So when the powers to be started thinking about, hey, we've got to come up with more products that are going to cast a larger net to bring in more buyers, specifically self-employed, since in California, about 62% of the population is self-employed. So when it comes to buying homes, because they're self-employed, they're going to take their tax returns and they're going to reduce the net income so that it reduces their tax liability. That's all great and dandy, but when it comes to buying a home, you don't show enough income. Hence comes in non-qualifying loans. Now, non-qualifying loans are going to be completely different than your qualifying loans. You're going to have the ability to verify someone's income with bank statements, okay? No tax returns, only 1099s if that's what they, get. So these loans are going to allow a much greater population, specifically self-employed, to qualify to buy a home. And in these products, we feel that it is a growing segment because now we're starting to see tremendous traction with self-employeds being approved with these products, non-QM products.
I think, that's an important point that you bring out, Abel, because in our industries, real estate, that sometimes a lot of money comes in and then sometimes you go through these dry periods, right? And seeing that you said that 62% of Californians or people in California are self-employed, it goes to reason that loans or the ability to have money work for you needs to be placed in California because it's such an economic motor for the United States, California. And seeing that I do come from San Francisco, it's so important to have these products, or at least let people know that this product is out there, right? Wouldn't you think?
Absolutely. And I mean, here's another one that's really important is with investors and rental property. Okay. You have a lot of investors that own rental property. They declare depreciation that helps in tax sheltering liability. So when you look at their tax returns, they also show very little income because they're writing everything off. Well, we have a non-QM product where as long as the rental income is equal or greater than the mortgage payment, that includes taxes, insurance, principal and interest, they're approved. They do not have to show tax returns as well. And, obviously, a couple of caveats. They have to be landlords or investors for at least a year, and they have to have at least a 620 credit score. But other than that, I mean, it is really a great product for those investors that can't show income through their tax returns, but their mortgages are low enough so that the rents are covering it.
Abel, let me ask you this question, and great information. So the non-QM, if I may, is it adjustable? In other words, the QM, I would imagine that it is fixed and it's probably the square that the feds want people to fit into. But let's face it, there's other people that aren't going to fit into that square, right? And so I just want to know if this non-QM, and probably our listeners want to know, will this have the propensity to adjust versus it not being fixed or it being fixed?
Paul, that is an excellent question because people need to understand that you are absolutely correct. QM means that little box with the best interest rate that you're going to get, because that's where the government would like to have the majority of the lending being done. However, because we are talking about outside the box thinking, there is going to be a premium, and it's not a lot. Right now, your 740 FICO, 80% LTV, money in the bank, they're going to get a 3.5, 30-year fix. Okay. With a non-QM loan, you're looking at 4.5, maybe 5%, depending on the credit score, but they are 30-year mortgages. So there is no adjustables. There are no negative amortization. All it means is that as a non-QM buyer, you are going to pay maybe 1.5% more than your regular 33.5% interest rate. But again, it goes back to understanding the big picture. I had a client, we ended up doing a bank statement loan. The rate was 4.75 a year ago. She now has made 18.5% interest, not interest, 18.5% increase in her equity on her property, even though she's paying 4 3/4. She says, you know what? It doesn't matter. I'm making wealth with this real estate that I bought because the value is going up.
Fantastic. That is such a good point to voice to our listeners. So, you know, it's so important for people to understand you might not be a seasoned investor, but if you see an opportunity, this non-QM really fits the bill. And like Abel was mentioning, the interest rate or the cost of that, you being or our listeners or anyone in real estate that is in the market to be an investor, you could make up that sum either by selling, or if you have income coming into the property that covers that cost and you're making money, you and your group, hey, it's a win-win situation, and it's a lot easier because you're outside of that square, so to speak, right? Well, fantastic, Abel. I really appreciate this question that you've answered for us, but we do have to break for a commercial break, and we'll be right back. Listeners, our next question is, where is the real estate market heading? So don't go away. We'll be right back.